Ladies and gentlemen, welcome back. I believe that the entire commodity sector, the entire sum of hard assets, not only gold and silver, but also copper, platinum, palladium, oil, natural gas, and some of the agricultural commodities are on the verge of a significant breakout. So we're talking about the extension of non-fiat asset classes. I want to show you the significance of this because this is how I'm going to be aligning myself personally over the next several years with our firm's capital. That's what we're going to be doing. And I just want to show you the reason why, in case this makes sense to you and you want to do something similar. So let's take a look. This is Christopher Aaron. Welcome back. It's June 26th. So I'm talking about the commodities sector. And the reason, let me show you one of the data points as to why I'm interested in this and why I think there is a major opportunity setting up in this sector, not just this week or next week, but over the next 2 decades. So we're looking here at a ratio. We're looking at the ratio between the commodity index, an average of 19 commodities, and the stock market, the US S&P 500. Going all the way back, let's call it a generation and a half. Okay, through the present, we have some room here for an extension. Now, one thing should be incredibly obvious from looking at this chart. We are talking about, as a ratio, the valuation of 2 things which cannot go to zero, right? The sum of the commodity sector cannot go to zero, and the sum of the U.S. stock market cannot go to zero, unless literally the world is about to blow up. I don't think that's going to happen. So therefore, neither of these are going to go to zero. Yet, this is the lowest ratio between stocks and commodities of all time. Okay, so the cheapest that commodities have been versus stocks of all time. And I would just say this as a general principle here, that if you think about this, if you like to do ratio analysis, which I suggest that you do periodically, but when you're looking at ratios, if you see a ratio of real asset classes, I don't mean just a ratio of one stock versus the S&P 500. I don't just mean a ratio of one gold miner versus the price of gold. I mean the sum of real asset classes. When you see a ratio which cannot go to zero, yet it's the closest to zero that it has ever been, well, I am interested personally in a situation like that, and I suggest you become interested in it as well, because simply a mean reversion, simply a reversion from here lower than 0.1 on the ratio, perhaps back to 1, would be over a 1,000% gain for the average commodity, let alone could we get back to some of the figures from the 70s or 80s. Simply staggering. So anytime you see this with the real asset class ratio at an all-time low, I think we should be interested. So let's take a look at this. It's very interesting to notice this pattern which is shaping up. So here's the all-time high in commodities. Here's that 40-year low we were talking about. Look at the pattern. Let's bring up our little handy key here. Look at the pattern that is shaping up. This is the breakout that I think is getting ready. Now, I think this is going to be an interesting time. And when we see this breakout, I do not suggest chasing it on the initial move, because I think this breakout could be something that gives us a mini breakout. We're talking about this terminal wedge pattern here, where you see the highs coming down at a very steep slope, right? There can be no negating that these highs are all matching up for a reason, especially these recent ones, 2018, 2019. And look at the lows coming down also, but at a lesser slope. So we see the convergence of the highs and the lows. This is called the terminal wedge. Don't believe me that this is a reversal pattern? Let's take a look. This is what got me interested in the silver market, just by the way, in 2015. Okay, it was right back here that I began publishing research on the silver market. I said, this is forming a terminal wedge. We can see that in blue. The highs coming down, the lows coming down, but at a lesser slope. Sure enough, this thing broke out in the beginning of 2016 and had that nice 75% move in the price of silver. And a lot of the mining companies went up 2 or 3 or 400%. So terminal wedge, that was a 3-year terminal wedge. Go back to the entire sum of the commodity sector. Not a 3-year terminal wedge. What is this? A 12-year terminal wedge. This thing is going to be massive when it breaks as far as the ramifications. However, I don't think it's going to be simply as easy, I want to show you why, as simply buying commodities now and holding for the next 10 or 20 years. I don't think it's going to be that easy. Okay, so I think we have an initial breakout here. If this doesn't manifest here over the next several weeks, it'll be coming definitely over the next 6 months or so, right here into the end of this terminal wedge. These patterns tend to not reach the very apex. They tend to resolve somewhere here in the 3/4 range, which is right now. So I think we're going to have an initial pop, but here is where it's going to get challenging for commodity investors. Now, we've backed this all the way out again to 1975. And I apologize, the years got covered up here. This is 1975, 1985, 1995, etc. Now, look at how this pattern is the exact same pattern that formed after when? This was the 1980 peak in precious metals. Now, think about this for a minute. This is when gold, silver, oil, copper all peaked in the year 1980. And we know some of those commodities, such as gold and silver, we can know that looking back at the past, we can know that they didn't indeed form bubbles at this time, right? Because they gave back 75 or 85% of their gains, that especially that move in silver. So this was the peak here in 1980, and notice how it was the exact same pattern that broke to the upside that showed us that this market was transitioning from a downtrend to what? A consolidative trend. Now, this is even a longer pattern that's formed here. This is a 12-year terminal wedge, whereas this was a 7-year terminal wedge. 1980 to 1987, beginning of 88 is when this broke out. Let's call it 7 full years. So the key thing, though, to look at here, when we have an even more significant pattern in commodities, right? A higher peak here in commodities than the 1980 peak, and also a lower bottom than the 1980 peak. Can we fathom that? How extremely bifurcated the commodity market has been over the last 10 years or so. Now, look at what happened as this pattern broke out. And here's why I think this is going to be challenging for commodity investors, and this is why I want to offer research on the entire commodity spectrum for those who care to be beginning to make their investments in this sector over the next several years. Okay, so we were just looking at this, by the way, in the last slide. So the break of this terminal wedge pattern, this is something where it's really important to understand the ramifications. When you have a multi-year terminal wedge that breaks, it tells you that this steepness of a decline is not going to continue into the future. And sure enough, you can see that. These highs that were coming down, this market broke that series of lower highs and never fell back below that trend, right? So it shows us that the steepness of the downtrend was getting to end, but it does not tell us that a new bull market is necessarily going to begin right away. That's the thing. I think a lot of people get a little too trigger happy right away, thinking that when a terminal wedge breaks, it means buy and hold for the next decade. It does not. Because what happened here in 1988 is that the entire commodity sector, after it finished moving down steeply, it basically moved sideways with including a few new nominal lows, a few percent below these bottoms here for 15 years. Let's call it 88 through the end of 2002. Okay, 2003, this market began to take off in the next major bull market. We know oil went from about $15 a barrel to $147. Natural gas went up 8 times. Copper went up 8 times. Gold and silver all skyrocketed, right? Everything went up. But there was a 15-year gyration consolidation here before that bull market got ready to take off. So if you think about that, right? Because people are attracted to flashy headlines. People are attracted to, hey, the bottom is in, or we have a breakout of this pattern, new bull market, new skyrocket. It's not always that easy. So this is a more significant pattern, and I do think there is a major opportunity setting up here, but I think it's going to be more challenging than just getting on board for a 5 or 6 year bull market. I think we have another gyrating basing period ahead of us. I mean, if you think about it, this 7-year pattern led to a 15-year consolidation. What does a 12-year pattern lead to as far as consolidation before the next bull market? That's the question. How long do we have? I would say at the very most, we can pretty much say with a lot of certainty that there is going to be some back and forth for a number of years that has to happen before the next bull market. This is what I'm getting ready to participate in personally. Going to be making some investments, especially in copper, in natural gas coming up, and then some trades coming up, as we talked about in platinum. And I also think there's a good trade setting up in oil. So different commodities are going to be appropriate for different time horizons. We were just looking at the average of all 19 commodities in the index. Key takeaways of this lesson, studying this pattern, okay, this long-term basing pattern that is about to be setting up. To be successful, investors have to focus on the following 2 things: grade and trade. And this really depends on the type of investor that you are. Grade. If you're going to be investing in the mining or the resource extraction companies, whether they are silver miners, copper miners, the few platinum and palladium miners that are out there, natural gas producers, the grade of the deposit is going to be key, because if we get a gyrating basing period that lasts for a decade or two, low-grade deposits are simply not going to be extracted from the earth because they will not be economic at any point in the near future. So high grade is going to be what is developed. The second thing is I believe investors need to be ready to trade these price swings during the extended consolidation. And this is where my research is going to come into play. And this is what I'm really excited about because I think the opportunity is going to be, and I don't like to be day trading these things. That's not the kind of trading that I'm talking about. But I'm talking about every several weeks, every several months, sometimes up to a year or so, these price swings that are going to form in the price of silver, in the price of oil, in the price of copper. I think this is going to be very important during an extended consolidation. So I want to thank you. I think that this market is getting ready for an initial pop. Go back to that first slide of the CRB commodity index, and I think this market is getting ready for an initial nice surge. It could be a 10% surge. It could be a 20% surge. I think most of the commodities are going to move higher, but then I think the market is going to top out and begin a gyration period. So we need to be ready for that. Long-term investors, I mean, if you're young, if you are 18 or 25 right now, you may consider yourself a long-term investor where every quarter or every year you are averaging your way into commodity producers. I think that could be an excellent strategy when you remember that that ratio between commodities and stocks is literally the lowest that it has ever been in the history of data keeping. Can't go to zero. So I'm going to be publishing more videos like this on the specific commodities as well as on this average of commodities that we just looked at over the next several months and over the next year. And then we'll be diving into this deeper, including the real-time trade alerts that we're making here with text mobile messages to your phone. This will be in the new Global Market Intelligence Service. This is coming in July. I'm really going to be holding myself to this to try to get this out in July. There's been a lot going on. It's been a long time in the coming, but I'm excited about this. So you can sign up to receive a free notice when this is ready on the link below. Existing service is called Precious Metals Intelligence. This is for gold, silver, and gold and silver mining investors. It contains all the information here. And I will say we had a flash, a special video update that went out last weekend, which was the definitive investigation as to all of the historical negative divergence periods that we've seen between the gold mining sector and the price of gold itself. Not just negative divergences, but positive divergences. There were 5 of them in total over the last 45 years. So we've looked at one of them here, the most recent one setting up. Very big video that went out a few days ago. I also work with individuals, just to let you know. I work from an independent standpoint, and I have clients across the spectrum. There's nothing too big and nothing too small that we can't handle here. I can tailor this research and the strategy sessions that we do according to how we would act if we were in your situation. That's how we do this kind of thing. What would I do if I was in your situation? Every person is in a unique situation, so no single data point applies to every single person in the world, but there are some common themes, and then we can tailor those themes to your situation across the commodity complex. Thank you very much to those supporting these videos on Patreon. I really appreciate your support. It means a lot to me. And just so you know, that's something that I never even intended to offer. And I had several individuals email me privately saying, hey, I don't want to subscribe to either your services, but I want to show my support. And I'm just very thankful that people reached out. So that's why I put that up there. Thank you again. Look for this breakout in the CRB commodity index. The initial surge should be a good tradable pop here coming up, at least over the next several months. And then after that, I think this market is getting ready to fool a lot of people. I think the bear market in commodities is almost over, but I think there is a gyration period ahead that is going to be better held by some discrete and concentrated trading. Thank you.